welcome back to our YouTube channel. Our topic for today is difference between stocks and futures. The first part we are going to discuss the difference because this is the common question being asked by beginners, and second part we are going to discuss exactly when to trade futures itself. And there are difference between trading FKLI and FCPO. When we are going to trade FKLI and when we are going to trade FCPO, they are totally different. So let's start with our topic for today. So my name is Ting Ting. If this is the first time you're watching our YouTube, please remember to subscribe to our YouTube channel and on your notification bell. As usual, we need to start with the disclaimer. Our topic for today is only meant for education purposes only. There's no buy or sell call. Now, there are many different between futures and stocks, and today I'm going to summarize into 6 important points to discuss about the difference between stocks and futures. Now, if we are going to look at the overview itself, stocks itself, we are going to look at different industry and sectors, their own company management, their earnings, etc. But in terms of FKLI, we are going to look at futures because we are going to compare index futures and stocks first. The rest we are going to compare in the later stage. For example, for futures itself, normally we are looking at the whole picture itself. For example, in terms of index futures in Malaysia, we have FKLI and FF70. For commodity futures, we have FCPO. But for this comparison purposes, we are going to compare at least apple to apple, for example, FKLI versus stocks. Now, second part that we are going to look into it is the expiry date. For stocks itself, for example, there's no expiry date. Technically, you can hold maybe for 100 years or even we hold for life. But for futures itself, technically, we can hold for that particular month itself only. So it will expire at the end of the contract months. But can you hold longer than that? Can you hold longer than a month? The answer is definitely yes. There's just a minor technical part which we just need to renew our contract, which is what we call as rollover in our industry. So we just need to renew it. But technically, because we own the contract, there's an expiration date. For example, if we sign a contract, definitely we need to input the expiration date. Now, the third part is in terms of direction. For example, for stocks, as you know that we can technically only trade one direction because during an uptrend, you can make profit, but during a downtrend, you can't make profit. But for futures, you can trade for both directions, meaning either uptrend or downtrends, you can long, you can short as well. So with that, both sides also you can make profit. For mark-to-market requirement, for stocks we do not have technically, for futures we have. One of the reasons is because stocks, we are not using any margin. Technically, you pay the full amount to own the stocks, but for futures, you are using a margin, meaning you're paying a deposit only. So at any point in time, when the market starts to move, the market will need to mark to market for your particular contract, and any differences you need to pay or you will receive in your trading account. So technically the terms is mark to market, meaning anytime the market will based on the current market price and calculate the difference, and they will calculate the profit and loss for you. Now, in terms of trading period, technically for stocks is longer, except that for those who are playing shorter terms nowadays, but for futures is shorter term because of the expiration in short. Now, the last part in terms of the form for stocks is technically you're owning the security asset and you own in a way your joint venture with another person or the rest of the shareholders to own a company. But for futures, technically you're owning a contracts only. Now, when to trade FKLI? So first thing, during an uptrend, if you do not know which stocks to choose, what you can do. So during uptrend, for example, in Malaysia, we have 900 over stocks and plus your warrant with more than 1,000 over counters. If you do not know or you have having a selection phobia, then what you can do is you can buy or you'll go for a long in FKLI. So when you long FKLI, meaning that you own a pool of stocks, so you don't need to choose. So with that, there's another thing is you don't need to choose or pick any stocks. So some of you are having this kind of selection phobia, you don't know which one to select, then you don't need to select. So technically you just long and FKLI contracts. So with the expectation, for example, upcoming, because of the economy is better, then you're expecting our stock markets to be booming or will be an uptrend, then what you can do is you can just go for a long in FKLI. You just hold a contract. Then you can avoid stock picking. Second, you eliminate stock specific risk. For example, if you only buy one counter, the counters that you bought might not go higher, but the general market is higher. So this is one of the ways that you can eliminate stock specific risk. And the third part is you can eliminate industry risk as well. You're not exposing to certain industry which is not performing during an uptrend, for example. But when you long FKLI, technically you are holding a few different stocks, so it will ease your decision making stage. Last part, you only take market risk itself. Now, during a downtrend, during a downtrend, you do not want to sell your stocks because you find that your stocks is undervalued, or you're going to for a longer term because this is a growth stocks. What you can do is you don't need to sell your stocks. You can protect your stocks. In fact, you can protect it by short your FKLI. I repeat, you can protect your undervalued stocks or your growth stocks in a way, or long-term stocks in your own definition, by shorting FKLI. So this is like what we call as hedging. This is another terms, but in short, as a layman terms, is like you're buying an insurance to protect your stocks. So when your stocks went down, what you can do is you can make profit via your FKLI itself. So this is what we call as hedge against your downside risk, because when the market is lower, your stocks, you are going to suffer losses. Now, the second part that we are going to discuss is when to trade FCPO. It's very different from FKLI, so we are going to separate this. Actually, it's very lengthy for me to separate between FKLI and FCPO. So I'm not going to discuss this topic, but technically you just need to understand when we are going to trade FKLI and when we are going to trade FCPO is very different. In short, for FCPO, is definitely you need to put it into your portfolio. You need to consider that about it. So later I'll give you some explanation about it, then take it into consideration. Now, the first thing that we definitely need to understand is because of the low correlation with our stock market. FCPO itself is very low correlation with our FBAM KLCI. This terms called low correlation in a layman terms is like relationship, very low relationship. So for example, I give you a layman terms is like in a company, if we have all guys, but guys and girls, they have different advantages and disadvantages. For guys and girls, it's definitely different. So if we can put both together, the company can grow better. Or else we can get two different people having two different advantages. We put together, we can grow the company better. So, but if both are having the same advantages and disadvantages, you cannot make the companies better in a way, because their know-how, everything, they are the same. So the same thing when it comes to our portfolio, we need to put two different products or two different characteristics of a products together, that at least you can perform differently. Now, I'll give you very different ideas. For example, I'm so sorry. Now, when our stock market is sideways trading, so technically you can't make money. But FCPO is a very major uptrend, so you can continue to make your money via your FCPO. Can you see that or not? The difference? So these are all the direction that you can see. Even during a downtrend, you can see that you are losing money in your stocks, but your FCPO is also downward trading. But don't forget, because FCPO is both direction, so you can make profit. You can continue to make profit via a different products. So you're not stuck with it. So as a whole, our portfolio as a whole, at least one of the products making money, the other products is not making money, is okay. If both one of the products is losing money, we do not have another products to compensate it or contra it, then there's a problem. So in short, you definitely need to consider to make or put FCPO in your investment portfolio. Now, there are other reasons as well. You can see, for example, different asset class from stocks. Definitely, we have different asset class. Try to put different asset class into our trading and investing portfolio. So we can technically we can compromise in terms of any time frame. For example, during a downtrend market in our stock market, we can use FCPO to contra it or to make money. At least we can continue to make money. Second part is definitely if you're trading in FCPO, is a direct commodity investing. You don't need to worry about the general market. For example, do you notice that our FBM KLCA has been trading towards the south side from 1008 to 1005, but our FCPO is still moving higher. So it's two different things. It's two different asset classes. So we don't need to take into consideration of that. So when you go with direct commodity investing, you can utilize or you can capture this advantage. Now, the third thing is definitely no stock specific risk. When you are trading FCPO, you don't need to select certain plantation sectors as well. You don't need to select certain stocks in the plantation sectors. So you don't need to depend on these particular companies in terms of their earnings, company management, etc. So this is what we call as you eliminate the stock specific risk. And the last one is definitely you also eliminate the industry risk. So for example, if the industry is not doing well, it doesn't matter because it doesn't affect our commodity itself, because our commodities is purely depends on the supply and demand. And second thing is because the nature of futures itself is both sides also we are going to make money so long as you are going or trading in the correct direction. So technically you are eliminating the industry risk as well. So our topic for today, we are going to end here. And before I end, remember to give us a like, a thumbs up, and remember to subscribe to our YouTube channel and on your notification bell. We are going to see you in our next class. Bye bye.